Now we will cover some long-term solvency measures. These measures measure a firm's ability to meet its obligations or its financial leverage. These ratios are also called financial leverage ratios or leveraged ratios. The total debt ratio. The total debt ratio takes into account all debts to all creditors. The formula is total assets minus total equity over total assets. In our example, our company has $3.5 million in total assets and $2.5 million in total equity. We'll take the difference of total assets and total equity and divide it by total assets of $3.5 million to have a total debt ratio of 0.286. In this case, we could say that this company consists of 28.6% debt, or that they have 28.6 cents in debt for every dollar in assets. Whether this is good or bad depends on whether or not the capital structure of the company matters. Now we can introduce some additional variations of the total debt ratio. One variation is the debt to equity ratio, and it equals total debt over total equity. We can calculate this by pulling the numbers off of the balance sheet, or we can use the ratios that were already derived from the total debt ratio. That would be 0.286 over 0.7141, giving us a total debt to equity ratio of 0.4 times. There's also a ratio called the equity multiplier, and it equals total assets over total equity. In our example, we have 71.4 cents in total equity for every dollar in assets. Therefore, the equity multiplier would be 1 over 0.714, equaling 1.4. Notice that the equity multiplier is 1 plus the debt to equity ratio. Given any one of these three ratios, and you will be able to calculate the other two without looking at the numbers on the balance sheet. These ratios are basically saying that for every dollar of equity, there is 40 cents of debt to go with it. Another ratio used to measure long-term solvency is the times interest earned ratio, also known as the tie ratio. There are several definitions, but the most common definition for this ratio is earnings before interest and tax divided by interest. In our example, our earnings before interest and tax is $638,000, and the interest that we pay is $154,000. Therefore, our tie ratio is 4.14 times. This ratio measures how a company has its interest expense covered. For our example, the earnings before interest and tax cover the interest bill 4.14 times. A problem with this ratio is that non-cash expenses such as depreciation and amortization have been deducted out of earnings before interest and tax. Therefore, it is not a true measure of the firm's ability to pay its interest. The cash coverage ratio. The cash coverage ratio is another measure of how a company can pay its interest. However, unlike the tie ratio, it takes into consideration the fact that depreciation and amortization are non-cash expenses. The cash coverage ratio is defined as earnings before interest and tax plus depreciation and amortization divided by interest. The numerator is earnings before interest and tax, depreciation, and amortization, which is the basic measure of a firm's ability to generate cash from operations.